Nominal versus real exchange rate. The exchange rate between two currencies reflects the price of one currency in terms of the other. This can be expressed as a nominal exchange rate, which is the raw, unadjusted exchange rate, or as a real exchange rate, which takes into account the relative price levels of goods and services in both countries. Understanding nominal exchange rate direct quote. This expresses the price of one unit of the foreign currency in terms of the domestic currency. For example, a direct quote for the USD-EUR exchange rate of 1.10 would mean that 1 euro costs 1.110 US dollars. Indirect quote. This expresses the price of one unit of the domestic currency in terms of the foreign currency. Using the same example, the indirect quote for the USD-EUR exchange rate would be 0.9111.0, meaning 1 US dollar costs 0.91 euros. Calculating real exchange rate. 1. Identify the nominal exchange rate. This is the raw, unadjusted exchange rate between the two currencies. 2. Determine price level indices. Use price indices like the Consumer Price Index, CPI, to measure the price levels of goods and services in both countries. 3. Calculate the real exchange rate. The real exchange rate is calculated by adjusting the nominal exchange rate for the relative price levels. Implications of real versus nominal exchange rate. International trade. Real exchange rates influence a country's competitiveness in international trade. A stronger real exchange rate can make exports more expensive and imports cheaper, affecting trade balances. Investment decisions. Investors consider real exchange rates when making investment decisions, as they reflect the true return on investment in different countries. Purchasing power parity. The real exchange rate plays a role in assessing purchasing power parity, which suggests that similar goods should cost the same in different countries after accounting for exchange rates.